every single year. There's a lot of volatility in the market.
If you lose 50%, it takes 100% to gain back.
So if you're panicking, that tells me two things. You don't have a plan and you have too much risk.
Why did you feel that this topic was so important?
We don't want you to panic. Welcome to the Financial Leadership Podcast. I'm David Afraimi, CEO and co-founder of BAM Advisory Group. Each week on the show, we're going to talk about how to build lasting wealth, take control of your financial destiny, and lead with confidence in every aspect of your life. We'll also dive deep into what it truly means to be a financial leader for yourself, your family, and your community. Let's go. Let's be honest, when headlines scream about the worst day ever in the stock market, it's easy to feel like everything's off track. But here's the truth. Market fluctuations are expected. They're part of the journey, not a reason to panic. In this episode, we're going to pull back the curtain on what really happens during those turbulent times. We'll walk through historical data that shows just how resilient the markets have been and why long participation matters and how missing just a few of the best days can change everything in your portfolio. More importantly, we're going to talk about the role of having a sound financial plan, because when emotions rise, your plan should bring you right back to center. So whether you're a seasoned investor, approaching retirement, or just looking for perspective during a rocky market, this episode will help you zoom out, stay grounded, and focus on what actually drives long-term success. Let's jump right into it. All right. Markets are crazy right now, right? So what we're going to talk about today is that markets in perspective. I think that a lot of people get really emotional. They panic. They start calling your advisor, get me out of this. So we're just going to kind of take a long view of the stock market, right? Because I think in volatile times, most people look at their investments in a peephole. And in a short period of time, if markets are volatile, it looks really bad and scary, right? I think if we look at the long view, and again, we're going to talk about planning. If you have a plan, a good advisor that puts a plan to get together can navigate you through market times and make it make sense to you, right? You don't want to dismiss, as a financial advisor, we don't want to dismiss the emotion, because how our clients feel are very important. We want to understand that your money is important to you. But, you know, a good financial advisor is really the non-emotional individual that you've hired that's invested in your success as well, but wants to be rational, right? We want to be surrounded by people in our lives that are leaders. We consider ourselves not just financial advisors, but leaders that can really navigate your fears, navigate your concerns, and illustrate it in a way that makes sense and is rational. So we're going to kind of talk about that today. So we've got some slides. Yes, this is going to be a podcast that's going to be very informative. Take notes. We're going to talk just about the markets in general. So this slide here.
So David, real quick, before we get into that, you sent this to me this week. And why did you feel that this topic was so important?
Yeah, so I've been doing this 25 years. And I was hired to the firm that I worked in late 99. In late 99 was the tail end of probably one of the greatest stock market booms that we've ever seen, the tech boom. And within 6 months of my career, the 2000, 2001, 2002 market correction was the most devastating at that time. You know, the last correction before that was 87. So from 1987 almost to 2000, it wasn't a straight line, but we've seen unprecedented growth. So I remember people just panicking, people losing half of their net worth in basically 18 months. And, you know, people were devastated, had to go back to work, had to sell assets, had to live off less. And then you thought the market recovered. And then what happened 7 years later? 08, 09. That was basically the lost decade. I mean, if you had money invested from 2000 to 2009, 10, you didn't make any money. So, and then of course, you know, from 2008, 2009, then we didn't really have any volatility or COVID. So I've been like, our planning is designed to weather these storms, because even though the type of volatility that we're seeing now doesn't happen often, but when it does happen, you better bet your damn dollar that your plan better work and work good.
Yeah, and there's obviously no question that right now, the last few months in the markets have been incredibly tumultuous. It's been a wild up and down ride.
Yeah,
for a lot of folks.
The NASDAQ is down 17% from its all-time high, and that's a lot of money to lose. Like, it takes years to make money. Man, it's overnight where you could, you know, potentially see it dissipate.
Yeah, and we've talked before, you know, we used to teach that math back in the day that if you lose 50%, it takes 100% to gain back in your portfolio, especially if you're all in that that growth bucket, it can take a lot to make that back. So obviously this topic today of understanding markets and David's topic is obviously very prevalent because of what's going on in the economy today. And hopefully David is going to address some of that.
Yeah. So again, first and foremost, before we get in these slides, is if you have a plan, if you go back and watch previous episodes, we have a 3-bucket approach. Your protection bucket, again, is your cash bucket. It's your emergency bucket. And right now, we've been going to our clients we always have our clients have a good amount of reserves. This is a great time, if you believe buy low, sell high. This is actually a great time to take money off the sidelines and put it to work. If you have a long-term view, then you have your income bucket. Generally, your income bucket should not really be affected, ideally, with what's going on. So your monthly paycheck in retirement still continuing. Sure, you're seeing volatility in your growth bucket, but that's money that you shouldn't need for 5 or 10 years. So the first slide that I want to talk about, we're not going into detail. It's just a really busy slide. It just shows you from 1970 through 2024, all the different events that have caused market volatility. There's 100, I don't know, there's 60, 70 things. So what we're witnessing right now is just normal.
Right.
It's just normal. But one thing you will notice is that, and another slide here we're going to talk about, we have a chart that goes back 99 years, and I'll just pull that one up right now. If you go back 99 years to 1924, we're going to get there here in a second. All the different bull and bear markets, essentially the stock market is positive 73% of the time, going back to like the 40s, the market's been positive. The tough part is that those other 27 times is if you don't have a plan around those, that's when it could be tough. You know what I mean? 3/4 of the times, generally the markets are positive. 1/4 of the time they're bad. But if it just happens to be it's bad during your retirement and you're withdrawing money from that growth bucket, you don't have a plan. That's where it really could be devastated. So what we're hearing people say, and it's not our clients, a lot of it's protected clients. And then let me just go over this first before we get to the next slide. This is what we call staying the course. So if you notice here, this is a history of the S&P 500 going back to 1980, right? 1980 through 2024. Anything in the orange, which is a negative return, is intraday year low or intra-year low.
Explain intra-year.
Yeah, so let's go to my favorite year, COVID.
Whoa.
Okay. So in COVID, which is right here, 2020, the S&P hit an intra-year low of 34%. That was the lowest point of the S&P 500 during the given year. So that was March of 2024.
So for somebody listening who may not totally quite understand that yet, if the market was up 16% in February, COVID hits, then the market goes down 34% is what you're saying.
That's the lowest point of the year right here. So
it went like this, like it always does, but at the lowest point it was 34%.
In 2020, and I know this was March of 2020, the S&P hit a low of 34%. So what I'm getting at is if you panicked here, went into cash, right, and were scared crapless, because a lot of people were, let's be real.
Yeah.
But this blue bar, if I go all the way top, the blue bar is what the S&P ended up that year with the return was that year. That's a 50-point swing. So if you went into cash, right, and stayed there, you missed a rebound of 50%, and you would have been up 16% if you just would have stayed invested. That's the theme of this staying the course.
You also talk about too, we talked about it in the last episode. For those of you who haven't seen them, you can go look at 3-bucket approach. You can go look at sequence of returns risk. This is also what you're talking about very often when you talk about income strategy. When, if you're pulling income in this particular year and it isn't planned properly, a minus 34 dip plus taking 5, 10, and 12% out of your portfolio, you're looking at total losses of almost 50% if you're not properly aligned with an income strategy.
If you're retired, when's the last time you put your resume on LinkedIn?
You got to dust that thing off.
No, you would have to go on to LinkedIn at this point, because if you're taking withdrawals and the market's dropping 34%, you're in trouble. Now so the S&P, obviously the NASDAQ's been down somewhere around 17% from its all-time highs, but the S&P's hovered around 10 or 12% down. Let's go back just 2 years. Like, people are panicking right now, but you just go back to 2020. In 2022, where they raised interest rates 4 times, The S&P hit a low of 25% that year. So we're not
with negative 19% total return.
Yeah, so that was the last bad full year in the market. Is what I'm saying.
You're making a great point though. Like, for people to sort of settle down and let it simmer, it's not the end of the world. If you do look at a full comparison graph, it puts things into incredible perspective about.
Well, what I'm getting at is just go back from 2008, 2009, go every year after that. And this chart says it. The S&P averages a drawdown of 14% every year. And we're about at 14% more or less right now. So if you're panicking, that tells me two things. You don't have a plan and you have too much risk. And your advisor's not proactive and reactive. Every single client that we work with at BAM Advisory Group, we ask them, what is your risk level so that if we get to it or past it, you're going to panic and call us? Because we don't want you to panic.
What does that normally look like?
It depends on the client. We don't have two clients are the same, but I could say it ranges anywhere from 15 to 20%
of total assets.
Of total assets. So if you've got 2 million, some clients will say, hey, anything after 400,000 is too much for us. And guess what? Most people come to us and their risk level is way out of whack. Way out of whack. Why? Because their advisor reactive. You work with an accumulation advisor, not a distribution advisor. So you're not working with someone who's paying attention to this. So the first thing we do is make sure we solidify your income and dial in your risk. So what this chart basically says, if you're watching this, is every single year there's a lot of volatility in the market. It's just, what is the new reason? And I think because of the new, current president who's, a little boisterous, whatever we don't want to get into politics here. It's just that for some reason right now it's the new thing. So people are more panicky. And just 2 years ago when the other president was in office, the market was a lot worse. So what's the difference? The difference is if you still don't have a plan and your risk isn't dialed into your pain tolerance threshold, your advisor's not doing their job and you need to, find someone. Come talk to BAM Advisory Group. We fix this stuff every single day. Yeah,
you're saying market fluctuations are expected and part of a long-term investing strategy, that corrections happen regularly and often recover quickly. The market has, obviously shown resilience through crisis. And if you have a plan that accounts for all of those things, you can sleep better at night.
Yeah. So now we're going to talk about the slide on staying invested. It's called Missing the Best Days in the Market versus trying to time it, right? Because I talk to people all the time. They're like, well, I'm just waiting for the bottom. And I go, well, if you find out when that is, can you let me know? So this is an example of someone who invested $10,000 and we're going back till, 1979. So this is investing $10,000 from basically the start of 1980 through the end of 2024. So that's 44 years of investing.
And this is in the S&P.
It's S&P. So if you put $10,000 and you just stayed invested, now we just talked about all the different volatility from 1980 to 1924. There's been a lot of volatility, right? But in this first example, someone that just stayed invested. So that $10,000, you got 1.7. If you missed the 5 best days over 44 years, look at the difference in your portfolio value. 5 of the days. If you missed 10 of the best days over 44 years, now how many days are in 44 years? What's 365 times 12 times 44? That's a lot of days. That's the answer. If you missed 10 of those.
200,000.
So 200,000 days. And if you missed 5 of those, 5 of the best days of those 200,000, the 5 best, your portfolio's in half. If you missed 10 of the best days because you sat on the sidelines and you thought this was the time or that was the time, you would have 762,000. If you missed 30 of the best days, 1 month out of 300, out of 12 times 44, it's a lot of months, right? 528 months over this 44-year period. If you missed 1 month, look at your portfolio value, $274,000. So essentially, if you go back and listen to the podcast, we talked about the 3-bucket approach. You have your income. You're not worried about it. Your growth bucket, since you're not touching it for 5 to 10 years, has the time to recover. So you can stay invested in that and you get the best outcome. Period. End of story.
Yeah, essentially, if you have all your eggs in one basket,
that basket's going to be broken at some
point.
And
the bike falls over and they were in that basket. Yeah, it's not good. No, I mean, it's that simple. I mean, we're talking about taking advantage of market opportunities while you have money that's protected for income, so that you're not having to have the anxiety and the ability to time markets and all those things that people shouldn't be trying to do that causes all that anxiety. With a solid plan in place, you get the best of both worlds.
Bingo. And here's just another chart that goes to what we're saying. So it's probability of positive returns. This is going back to 1937. What this is saying, in any given day, the S&P 500 has a 53% chance to be positive and then 47% chance to be negative. So you see a lot of volatility if you look at it per day. But if you go a month out, higher probability of, let's look at 3 years out. 3 years out, you have an 88% chance that your money is going to be positive. If you have a longer time horizon, you go 10 years out, you have a 97% chance of your money being positive. That's why your growth bucket cannot be the bucket where you're pulling your day-to-day monthly income. The stats show it right here. It's too risky to only have 53% probability in a given day for your money to be positive. It's just too risky.
Yeah, market timing is difficult and often results in missed opportunities.
Impossible. Even Warren Buffett doesn't time the market.
Yeah.
Now here's one other slide we want to talk about. This slide right here, again, is the S&P 500. It's going back to 1987 and is showing you the worst one-day return in the history of the market. And then the next column is what the market has done a year later. So the worst one-day return in the history of the stock market was not COVID. COVID had the worst month return. Was Black Friday.
1987.
That Black Friday, that weekend, that Friday and Monday. So 20% in one day. That is terrifying. But look at a year later. If you stayed invested, a year later, the market was up 23%. Let's go to the next worst day. This was right around March of 2020. And we had 2 of them in a row. Man, this was stressful. Max and I were actually in our car skiing on one of these days. And I said, Max, we got to call people. We called every single client. We pulled over. This is a true story. It was snowing. We were up at Keystone. We pulled over and we called every single client just to check in with them. So March 13th, 2020, the S&P 500 that day was down 12%. Where was it a year later? Up 66. Stay invested.
Long-term participation has historically outperformed short-term timing.
Yeah.
And one of the things you are talking about with 3 buckets and et cetera is how do I take advantage of my upside while protecting my downside at the same time?
Yes, there's a way to do it where we don't have to try to time it or predict it or do whatever. We'll go one more day. So basically, let's go all the way down. Here's the averages. The average, if we take all the top, 20 days, 21-day drawdowns in the market, the average is about 9%, the worst. But the average return a year later in the S&P 500 is up 30%. So what is this telling you? Is that if you have this 3-bucket approach and you actually have cash in your protection bucket, this should be a time where you're taking that money and slowly integrating it. You could do dollar cost averaging, which is taking a little bit of money monthly and investing. You should actually be buying these dips, not panicking.
Yeah, trying to avoid down days often means missing the best days too, is exactly what this is showing.
I mean, the future isn't a predictor, or the past isn't a predictor of the future. I know maybe this one is the end of the world. And if it is, who cares about all of our money? If that's the case, I shouldn't even be going to work.
Yeah, yes, we get to all go to heaven. Sign me up. Let's go.
I want to chill with Jesus.
I'm ready.
All this is saying is that, again, and Chris said it earlier, if you have a well-written plan, again, go back and watch some of our previous episodes. BAM Advisory Group, our unique one-of-a-kind solutions, the BAM Retirement Game Plan. It covers those 5 key worlds. Our investment philosophy is the 3-bucket approach: protection, income, growth. Go back and watch some of our previous episodes that talks about this. We've navigated our clients through the most tumultuous decades in the past 25 years, and our planning process continues to work. It's working right now. We don't have any clients calling us panicking. What our clients are doing is asking, is this a good time to put more money in? Think about that. You're retired, and because of how we've trained you and how we've planned for you, you're actually looking forward to market volatility versus panicking and stop spending, like stop traveling. Well, no, why would you want to do that? Makes no sense.
Yeah, and I would say, I mean, some of the best investors in the world are, like you said, David, they don't react to volatility. They are sound in their plan because they are diversified, which is another way to describe what we're talking about. And they do buy dips, and they aren't afraid of down markets because they do represent incredible potential opportunity for people to buy low and take advantage of those ups.
Yeah. Basically what a sound plan does, it helps manage the emotion, right? If you think about a coach, if you think about a doctor, if you think about a president, if you think about a general, a coach doesn't just show up the day of the game and tell their team, all right, guys, just go out and score more points than the other team. A general just doesn't gather their troops the day of battle and says, okay, guys, if you kill more,
run that way.
Yeah. If you kill more than they kill us, we're going to win. A doctor doesn't come in on a day of major heart surgery and just start slicing and dicing. No.
Even the preparation for this podcast takes days and weeks at a time to put together.
Plan, right? Yeah. So a plan, what a plan does is, you hope for the best, but you plan for the worst. A coach. Let's look at who just won the national championship.
Which sport?
College basketball. It was not Auburn. It was Florida. Florida just won, right? I can promise you this, that when Florida played the national championship game, the coach just didn't show up an hour before and tell his team to stretch and just get more buckets. They planned, they prepared, they put a game plan in. If game plan A didn't work, they had game plan B. They wanted to go at the opponent a certain way. Some coaches reformat their defense and their offense. A general is going to be a tactician when he's going into certain demographics, certain different countries. They've studied the opponent. A football coach plans for a 3-hour game a week or even 2 weeks before the game, and they spend these guys don't even sleep. They spend 20 hours a day planning. And most people come into our office with a portfolio. Having a 401k, ladies and gentlemen, is not a plan. Having a stock is not a plan. Having an annuity is not a plan. Having a life insurance policy is not a plan. You need a well-written plan that covers the 5 key areas in your investments, especially in companies that have a 3-bucket approach, right? Yeah. So, listening versus emotional intelligence will get you through. If you're a financial advisor and you're watching this, you really have to be listening to your clients right now, right? You've got to have high level of emotional intelligence. Just showing illustrations and graphs, which we just did, isn't going to be the only thing that's going to calm your clients down. It's really going to be making sure that.
Yeah. Reassurance.
Yeah. Reassurance, and just making sure that their plan is customized to them and their needs. And because if your clients are panicking, this is what it tells you as a financial advisor right now. If your clients are panicking, it's telling you this right to your face: you didn't do a good enough job managing their risk coming into this year. Because your client should know the deal by now. If not, you haven't trained them well enough. And if you're watching this and you're a potential client or investor, and you haven't had a risk analysis or a stress test on your portfolio, come see us, book a complimentary, no obligation call with one of our advisors, and we'll, do a bunch of stuff for you. One of them is checking your portfolio to see the risk level and making sure you're okay with it.
Yeah, there's never been a better time than right now to get a checkup on, where you're at, where you want to go, especially if you're nearing that retirement age and you haven't put a plan in place, or maybe even seen a plan. Maybe ever even seen an income plan. If this, you're hearing this and you're like, wow, I've never even heard someone mention that. Great time to check in and see where you're at.
Yeah, check in the show note. There's a link where you can schedule a complimentary, no obligation 15-minute call with one of our advisors. Because emotions are high. And if you're managing your own money and you're emotional, oh my gosh, it's like, why would you want to do that? It's like performing your own surgery. Could you imagine trying to give yourself anesthesia and then cutting yourself and,
while someone's yelling at you, and because it's not, the market's that bad. Someone's yelling at you. There's false news. There's constant messaging all day long. It's your life savings. I mean, it's intense.
It's intense.
Doing open heart surgery on yourself almost seems simpler
than managing your assets. Absolutely. Like no question.
So how do we wrap this up, David? So basically we're saying, to put this in a nice neat bow, that market fluctuations happen.
Yeah.
And that if you have a good plan, then it should potentially eliminate some of the stress and worry, which is what BAM is all about, is protecting what's priceless. That your team absorbs that for them.
Yeah. We're the non-emotional leader in your financial lives. We will make a sound, well-built plan that's thought out and make sure it's catered to you. Go back and watch one of our episodes, look at the 3-bucket approach. We talk about the sequence of returns and just managing risk. Look, nobody likes losing money. I've never met a client that wants to lose money. But if you have a well-written plan that where we are already forecasting market volatility, then it's easier to absorb. Bear markets, corrections, and periods of volatility are an inherent part of investing. No risk, no reward, right? If you're all in cash, that's actually riskier to be all on the market. Have a plan and only risk the money that you're okay with, meaning you should have a certain amount of money in growth. That should be the amount of money. If it goes down 10, 20%, it shouldn't affect the way that you live your life. And again, I just go back to one of my favorite quotes. Warren Buffett says, it's crazy to risk something that you have for something that you don't need. And if you are taking on too much risk in retirement, why? This is the time to enjoy life, not the time. Again, do you want unpredictable, unreliable, stressful income in retirement, or do you want predictability, more reliability, defined income? I mean, here's a great question. If you're watching this, have you ever been on a roller coaster before? Most people say yes. And I said, how many of you have ridden a roller coaster lately? Nobody raises their hand. I'm talking to people that are 50 and over. It's cool to ride a roller coaster, AKA have 100% of your money in the stock market when you're 20s and 30s because you're working and your money going up and down is not a problem. But when your paycheck in retirement is coming from your investments, the roller coaster ride is no longer fun. And it's time to lay on the beach, put your feet in the sand, and enjoy life. Once again, this is David Afraimi, co-founder and CEO of BAM Advisory Group, also a licensed investment advisor representative. If you would like to see how we help our clients protect what's priceless, how we've helped our clients for the past 25 years, please visit our website at www.bamadvisorygroup.com and schedule a no-cost, no-obligation meeting with one of our advisors. If you're enjoying the content and you're enjoying the show, please like and subscribe. Thanks again, and we'll talk with you soon.